Let's talk about something every investor, big or small, needs to understand. Even great businesses can become bad investments if you pay the wrong price. That truth doesn't come from a textbook. It comes straight from Warren Buffett himself, one of the greatest capital allocators the world has ever seen. And in a recent conversation, Buffett laid it all bare, speaking candidly about some of the best and worst decisions he's made and what they reveal about where business is heading in the modern era. It was a rare glimpse behind the curtain. He didn't sugarcoat anything, especially when discussing the Kraft Heinz deal, a decision he openly admits wasn't one of Berkshire Hathaway's finest. But the story isn't about regret. It's about recognizing patterns, understanding how the market evolves, and staying humble even after decades of success. Paying too much for a wonderful business. Buffett's commentary began with an honest admission. We paid too much for Kraft. While the acquisition of Heinz had been fair and yielded solid returns, including redeemed preferred shares and steady profits, the subsequent combination with Kraft turned out to be far more expensive than it should have been. He reflected, the business doesn't know how much you paid for it. And he's right. A company will earn based on its fundamentals, not on the price tag you slap on it. Even if Kraft Heinz is now generating an estimated $6 billion in pre-tax profits on $7 billion in tangible assets, which is a strong margin, overpaying at the outset limits your upside and extends the time required to break even. This is one of Buffett's classic reminders. The margin of safety doesn't just apply to volatile assets. It applies even to great companies. You can buy an incredible business and still lose money if you ignore valuation. Brand power is shifting, and fast. In an unexpected twist, Buffett pivoted to a bigger concern, the changing nature of brands and retail power. For over a century, legacy brands like Kraft and Heinz poured billions into marketing, creating household names that filled shelves in every supermarket in America. That strategy worked in a world dominated by TV, radio, and in-store shelf space. But we don't live in that world anymore. Today, the battlefield is shifting. Buffett pointed out that Costco's private label brand, Kirkland, is now a $39 billion brand, outperforming Kraft Heinz itself, which sits at $26 billion, despite 150 years of brand legacy and massive ad spending. The real shocker? Kirkland operates within just 775 warehouses, while Coca-Cola distributes across millions of outlets. Yet Kirkland is beating Coca-Cola in overall volume in some categories. That speaks volumes about the new dynamics of consumer trust. Customers no longer default to legacy brands. They follow value, convenience, and trust in the retailer itself. Amazon is another powerful example. The platform has effectively become a brand in its own right. People don't just shop on Amazon. They trust its curated results, default options, and private labels. This shift in consumer behavior is tilting the power dynamic away from traditional consumer packaged goods, CPG, companies, and toward retail giants who control the customer interface. The growing power of retailers over brands. For decades, CPG brands were the kings of the shelf. But now, in Buffett's view, retailers like Amazon, Walmart, Costco, and Aldi are gaining the upper hand. They're not just selling products. They're shaping customer habits. And in some cases, they're building brands faster, cheaper, and more effectively than the legacy players ever did. Buffett noted how different countries show varying degrees of private label adoption. In some markets, private label soft drinks make up 35% or even 40% of total sales, a level the U.S. hasn't reached yet. But the trend is clear. Control over customer access is becoming more valuable than legacy branding. For companies like Kraft Heinz, this shift means more than just a PR challenge. It's a long-term strategic threat. If they can't compete on price, brand agility, or innovation, they risk becoming obsolete in a market that increasingly rewards speed, flexibility, and direct-to-consumer strategies. And yet, despite these challenges, Buffett remains respectful of the operational improvements Kraft Heinz has made under current management. He's not throwing the company under the bus. He's simply acknowledging that the price paid for its acquisition was not in line with the value delivered. From cigar butts to quality businesses, Buffett's evolution. Warren Buffett famously began his career hunting for cigar butts, undervalued companies that had one last puff of value left in them. Over time, however, his philosophy matured. Today, he focuses on buying great businesses at fair prices, not mediocre ones at cheap prices. The Kraft acquisition, in his own words, didn't align with that philosophy. You can turn any investment into a bad deal by paying too much, he said. What you can't do is turn a bad business into a good one by paying a little. This is more than financial wisdom. It's a life principle. Overpaying, whether in time, energy, or money, always comes with consequences. And no amount of wishful thinking can make a poor decision profitable. Mistakes are inevitable, even for legends. One of the most remarkable parts of Buffett's reflection was his humility. He didn't hide behind jargon or spin. He simply said, "We made a mistake." And that honesty is what makes his insight so powerful. Charlie Munger, his longtime partner, added, "It's not a tragedy that out of two transactions, one worked wonderfully and the other didn't work so well. That happens. That's the kind of grounded realism that most investors need, but rarely hear. Mistakes are part of the process. What matters is how quickly you recognize them, learn from them, and avoid repeating them. That's what separates amateurs from professionals, not perfection, but pattern recognition and course correction. Let's talk about it. Everyone's had a Kraft moment in life, a time when you paid too much, moved too fast, or trusted the wrong metric. Maybe it was a job, a relationship, or a business venture. The real question is, what did you learn? And how are you applying that wisdom today? Take a second and drop a comment below. What stood out most to you in Buffett's reflections? Was it the shift in brand power, the cost of overpaying, or the humility to admit when something doesn't work out? Your voice might be the spark that helps someone else see their situation more clearly. And if this message hit home for you, share it with someone who needs to hear it. As the conversation continued, Buffett shifted focus from specific deals to broader strategy, especially how Berkshire Hathaway operates behind the scenes. While many companies centralize decisions and impose a rigid chain of command, Buffett and Munger have always championed something different: empowered management at the local level. This isn't just a philosophical stance. It's a structure that has allowed Berkshire to thrive in a business environment defined by change, disruption, and increasing complexity. And it might just be one of the most overlooked reasons for the company's long-term success. Decentralization, the quiet power of trust. In a world obsessed with metrics, dashboard, and control, Buffett does the opposite. He hires smart people who know their industries better than he ever could, and lets them run the show. Berkshire Hathaway is famously light at the top. No sprawling bureaucracy. No endless meetings. Just good businesses run by good people who feel like owners. And it works. Buffett pointed out that divisions like BNSF Railway, Berkshire Hathaway Energy, and Lubrizol are run by people who live and breathe those industries. They aren't being micromanaged by a corporate office that knows nothing about railroads or pipelines. They're trusted to make decisions, anticipate challenges, and lead with clarity. This approach has its risks. Mistakes happen. But in Buffett's view, the net benefit of autonomy, the speed, innovation, and accountability it fosters, far outweighs the cost of occasional missteps. There's a powerful life lesson here. Trust is more efficient than control. When people feel ownership, they act differently. They care more. They adapt faster. They rise to the challenge. The problem with traditional conglomerates: Buffett doesn't just praise decentralization. He also criticizes its opposite. Over the years, Berkshire has acquired businesses that were previously trapped in bloated corporate hierarchies. The feedback is often the same: endless layers of management, no clear authority, decisions made by people with no stake in the outcome. It's not just inefficient. It's demoralizing. Buffett recalled horror stories from companies that had to get permission from 3 different departments before making a simple change. By the time a decision was approved, the market had moved on. That's not how Berkshire operates. There's no need for a massive internal bureaucracy when the people closest to the problem are also closest to the solution. This clarity of structure gives Berkshire a unique resilience, especially in times of volatility, anticipating change instead of resisting it. One of the hallmarks of Buffett's philosophy is his embrace of creative destruction. He's not nostalgic about business models that no longer work. He doesn't cling to the past or pretend the market will return to the way it was. He knows better. Buffett pointed out that many of Berkshire's early businesses, textiles, shoes, department stores, trading stamps, no longer exist in his portfolio. Why? Because the world changed, and those businesses didn't keep up. This isn't failure. It's evolution, and Buffett celebrates it. Just think about agriculture. In 1800, roughly 80% of the U.S. population worked on farms. Today, that number is closer to 1%. Without change, we would still be a society stuck in subsistence mode. Instead, we become an economy of innovation, services, and technology, freeing up human potential for other pursuits. Buffett understands that some of the companies in Berkshire's portfolio will not survive the next 50 years. And that's okay. The goal is not to freeze time. It's to allocate capital to the future, not the past. Resilience through adaptation. This ability to pivot, financially, strategically, even emotionally, is one of Berkshire Hathaway's greatest strengths. Buffett and Munger don't mourn lost businesses. They redirect resources toward what's next. That's what real resilience looks like. Not avoiding loss, but responding to it intelligently. In a way, this mirrors our own lives. Things end. Circumstances change. Opportunities fade. But if we stay flexible, curious, and open to new paths, we can adapt. We can thrive again. That's the DNA of Berkshire. And it can be the DNA of your personal growth, too. The human side of strategy. What makes all of this more powerful is that it's not coming from a theorist or an academic. Buffett is speaking from decades of experience, both success and failure. He's seen bubbles, crashes, fads, revolutions, and recessions. And through it all, he's stayed steady. That steadiness doesn't come from being perfect. It comes from being prepared, from understanding that success isn't about always getting it right. It's about building systems that allow you to recover quickly when you get it wrong. Systems like decentralized leadership, disciplined investing, long-term thinking, humility in the face of market forces, and maybe above all, a commitment to keep learning, no matter how much you already know, what this means for you. So what does all of this mean for the rest of us? It means you don't have to control everything to succeed. You just need to understand where your strengths are, build systems that support them, and surround yourself with people you trust. It means you should stay alert to shifts in your own industry. Is your career or business model showing signs of decline? Are you clinging to methods that no longer serve you? Maybe it's time to reinvest your energy elsewhere, just like Buffett reallocates capital. And it means accepting that some things will wither and die. That's not a personal failure. It's a natural part of growth. What matters is what you do with the resources you free up. Take a few minutes and share this video with someone who needs a strategic reset. Whether they're a business owner, investor, or someone navigating a personal turning point, Buffett's approach to change is a roadmap we all can use. As Warren Buffett wrapped up his reflections, the conversation drifted towards something deeper than financial strategy, the meaning behind it all. Because after decades of navigating markets, industries, and institutions, what remains isn't just a string of wins or losses. What remains is legacy, and not the kind measured in net worth or awards, but the kind measured in lives influenced, in wisdom passed down, in frameworks built for others to grow from. It's easy to get caught up in charts, deals, and valuations. But at the end of the day, none of it matters if it doesn't serve something greater. Leadership that doesn't depend on titles. One of Buffett's most subtle messages is that you don't need to be famous, wealthy, or in charge of corporation to lead. Real leadership is quiet. It's consistent. It shows up in the way you carry yourself, the decisions you make, and the values you uphold, even when no one's watching. Buffett never micromanages people because he trusted them. He never chased headlines because he knew his true value didn't come from being visible. It came from being valuable. Think about that in your own life. Where are you trying to be seen instead of being solid? Where are you working for approval instead of building trust? The most impactful people aren't the loudest. They're the ones who create momentum without needing credit. A new way to measure wealth. Throughout his career, Buffett has accumulated wealth on a scale most of us can't imagine. But when you listen closely, you realize that his true riches have little to do with money. His wealth is made up of time used wisely, decisions made with integrity, relationships built on respect, a reputation earned over decades. This is a man who could have anything, but still eats breakfast at McDonald's, still lives in the same house he bought in 1958, and still walks to work with the same sense of purpose he had at 25. The takeaway? Wealth is not what you flaunt. It's what you quietly preserve, protect, and multiply with wisdom. And in a world obsessed with appearance, Buffett reminds us that the truest value often lies beneath the surface. Legacy is built in the everyday. It's tempting to think legacy is something reserved for greats, the Buffets, the Jobs, the Oprah Winfreys of the world. But that's a myth. Legacy is built in the small, daily choices you make. How you treat people, how you manage your time, how you respond under pressure. It's not about having millions. It's about having meaning. Maybe your legacy is teaching your kids how to handle money with integrity. Maybe it's starting that business you've been afraid to launch. Maybe it's helping someone else find clarity just by listening. You don't need a platform. You just need presence. Buffett didn't start as a legend. He started as a young man with a curiosity about numbers and a hunger to learn. He followed that thread for decades. And along the way, he built something much greater than a portfolio. He built a philosophy, a way of living that inspires millions. You can do the same, in your own way. When the game changes, adapt with it. Buffett has seen industries rise and fall. He's owned companies that thrived for decades, only to fade into irrelevance as technology or society evolved. And he never clings to the past. He reinvests in the future. This mindset is essential in a world where change is constant. Maybe your job isn't secure. Maybe your industry is fading. Maybe your identity is tied to something that no longer exists. Don't panic. Reposition. Change isn't your enemy. Denial is. The ability to shift direction gracefully is one of the greatest advantages you can develop. And the earlier you do it, the more control you retain over the outcome. Whether it's your finances, your business, or your relationships, don't hold on to dead weight. Harvest the lessons. Reallocate the energy. Move forward. The most powerful investment is in you. In the end, every one of Buffett's stories returns to a single point. You are your greatest asset. Your skills, your habits, your mindset, your capacity to observe, reflect, and grow. Markets may crash. Industries may disappear. But the person you become, through learning, discipline, and alignment, will always have value. So if you take nothing else from Buffett's wisdom, take this. Invest in yourself as seriously as you would a billion-dollar deal, because that's what you are, an enterprise of potential. When you strengthen your thinking, manage your time with intention, and lead with values, you become unstoppable. Not overnight, but inevitably. Keep learning, keep building. Buffett never stopped studying. He never stopped asking questions. That curiosity, that willingness to admit what he didn't know, kept him sharp. It's the reason he stayed relevant for over half a century. So ask yourself, where have I stopped learning? Where am I operating on outdated assumptions? Where do I need to evolve to remain valuable in a changing world? Your answers to those questions could be the beginning of your next breakthrough. And if you made it to the end of this message, you're clearly someone who values long-term thinking. Take a moment now to check if you're subscribed to this channel. Many people watch videos like this, but forget to hit that button. When you subscribe and turn on notifications, you ensure that insights like these find you again, right when you need them most.